Alright, just a quick run through of the weekly S&P 500 chart storm. This is what I do on Twitter every week. Just a collection of charts on the US market, and quite a mix in this week, but I guess the theme, if any, is overbought and overhyped. And we did do a write-up on Seeking Alpha. I'll put that link up into the information section of this video. Alright, the first chart is the S&P 500 daily chart versus its RSI, so 14-day RSI. And this is really a textbook overbought signal. So the rule of thumb is that overbought is when it gets to, these high levels around 70. But an actually, true signal is when it goes up to those levels and then rolls over. So we saw that only a couple of times actually. So one time late last year, and there was a very mild sell-off after that one, followed by a bit of sideways movement, which sometimes sideways is can be considered a stealth correction if the rest of things are going up. And there was also one earlier this year, so that looks to be in sort of February. Went into overbought territory rather, and rolled over. Slightly more of a sell-off on that episode, but anyway, the signal has come in again, and risk is fair to say would be elevated short-term in the wake of that signal. Then number two is really just another angle on this, and that is looking at the breadth of overbought stocks. So you can see there that it's showing the percentage of S&P 500 stocks with 14-day RSI above 70, and that's spiked up, and that spike has come down a little bit. So that's really just backing up that signal and showing that it is fairly broad-based amongst the constituents. Then moving into number three, so I already showed you there the overbought ones. This is the overhyped. So this is a picture of sentiment. This one is the TDIMX, or the Investor Movement Index. Shows a gauge of retail investors' bullishness or otherwise based on their trading activity at TD Ameritrade. And you can see there that it's spiked up to very high levels and rolled over. That, by the way, is something to pay attention to. So when you see a sentiment indicator, you want to notice when it goes to extremes. You also want to notice when it rolls over from an extreme. So that is something that I would be factoring in and considering, really equivalent or, alongside that overbought signal. Number four, this is my very own Euphoria Meter. Combines three different major inputs, which is forward P ratio, so the valuation, or another way to read valuation is confidence. Bulls sentiment, so bullish sentiment from the investor surveys, the Investors Intelligence Survey, and the American Association of Individual Investors. And then finally also the VIX, and that's a smoothed inverted view of that, and you can see there that all three components are basically in agreement, and that has helped push the Euphoria Meter, gauge of euphoria or otherwise, to the highest levels since the last stages of the dot-com boom, or you could say the final stages there. And again, with sentiment indicators, you've got to pay attention to those extremes, and it's another sign that the bull market is entering into the latter stages, certainly maturing. And speaking of maturing, this chart shows bear markets overlaid against the ISM manufacturing PMI. And the point of this one is here, you can see in the title, it's not unusual to see the ISM peak just before a bear market, and that just speaks to the fact that market cycles and business cycles often travel together, and you usually get a bear market as a result of one of two things. You get it because of some sort of shock or crisis, or you get it because the fundamentals have started to deteriorate, or the the business cycle has actually matured and rolled over. And, that's why, I mean, certainly, um, you look at a lot of the economic indicators at the moment, and they look pretty strong. They certainly look later cycle. But, if we did get a correction or a sell-off tomorrow, it, all else equal, unless there was some sort of crisis, or unless the economic indicators turned on a dime, you know, the risk of a bear market doesn't look very high at this stage just yet. And speaking of fundamentals, this one here, number 6, shows dividend growth year-on-year basis. And you can see that it's actually ticked up a bit. So, something that I note on this one in the write-up was that, for income-oriented investors, it's not just the dividend yield that's relevant, it's also the growth of the dividends. So, that's another chart that sort of supports the idea that the fundamentals are kind of supportive to it. And this one, I guess you could put this into the sentiment bucket, and shows the VIX. So it shows the green dot is the highest reading for the year, the red dot is the lowest reading for the year, and the blue or black dot there is the average for the year. And I believe the CBOE noted that if if the VIX trades sort of, I think it was 15 or more, an average of 15 or more for the final quarter, then it'll, or if it trades under that, it's going to be the lowest on record. So that is quite remarkable. It's this period of low volatility, overbought markets and overhyped markets, and the overvalued part will come in at the very end. But before we get to that, another look at a fundamental chart. So this one here, number 8, shows profit margins for America and Europe. So there's a couple of things to note there. First is the gap between them, America vastly outperforming Europe, and the other point is that American profit margins have recovered from that sort of micro recession that took place in 2015-16. Number 9 shows a divergence or a disconnect between the price and the cycle composite, which combines the decennial cycle, so the 10-year cycles, and the presidential cycle, and the annual seasonality cycle. And you've had this disconnect here, so I've sort of posed a couple of questions. Is it a good sign that the market is defying that cycle? That things are so good that it's that downward cycle part is sort of being irrelevant or ignored, or is it just a stretching of the rubber band? And I think there's probably elements of both in there. The animal spirits and decent fundamentals, they're certainly helping it perform where otherwise it might not. But oftentimes these cycle things, they're there for a reason. So they're not to be ignored as such. They can and do break down, but I guess it's just another it's another sort of sign of the times of the market that we're in. Onwards and upwards, but then you keep on getting things like this. Number 10, the final one, price to sales ratio. And you can see there that it's at very familiar territory, very similar to dot-com era. Now, I would note a few caveats about this one. So first of all, profit margins are a lot higher now. There's also been a change in composition gradually across time of the index, across sectors. And I guess it's also worth reminding that investors, stockholders, they don't get sales, they get earnings, or more to the point, they get dividends. So, for all its shortcomings, it is a very interesting indicator and very interesting the levels that it's got to, particularly in the context of what I mentioned at the start of this about, the overbought conditions. So you've got overbought overhyped, overly complacent or overly calm, and overvalued. So it's a very extraordinary market indeed.